All right, guys, I think we have a quorum. So thank you to everybody for joining us here today. We're going to talk about investing in a presidential election year. These are years that tend to come with a lot of hand-wringing and anxiety. So we spent a lot of time looking back at how markets and the economy tend to perform in years when we have a presidential election. I've been in this business for several decades, and there's always a sort of extra amount of trepidation that goes into a presidential election year. But I think some of these results are actually going to surprise you. So hopefully we can, provide a little bit of perspective as you think about your portfolios and the economy and, what to expect post the election as well. Before we get into data, because you will discover that I do love data and charts, we're going to have fun with a little bit of trivia and test how well your knowledge, how good your knowledge of American politics is. So if we could bring up the disclosure slide briefly. And then our first question. So when was the last time there was a presidential election rematch, and who were the candidates? So in this case, it would have been two individuals who had previously run against each other in a presidential election. So when was the last time that that happened? And I will warn people, there's hardly been anybody who I've asked this question who's gotten it right. But it was Eisenhower and Stevenson in 1956. So those two individuals had run against each other 4 years earlier. Eisenhower won by a landslide. And he went into the next election, a very, very popular candidate, and actually won by an even larger landslide in the second matchup. Now, this question was a little more relevant a few weeks ago when it was going to be the second time that we had a rematch. Now that Biden has dropped out, the Eisenhower versus Stevenson will continue to be the only time in American history that we've ever had this happen. So second question is, who was the only president to lose his reelection campaign and then run again to win a second non-consecutive term? So this is what Trump is doing now. He ran, lost his reelection bid, and now is running again for a second non-consecutive term. So that would be Grover Cleveland. And I think this is particularly interesting. Shortly before or around the time that Grover Cleveland was inaugurated for his first term, a financial crisis hit, which plunged the economy into a deep depression. So real economic hardship during his presidency. And the public blamed him for allowing this to happen, even though it had really started before he even entered office. So he left a very unpopular president. Over the next 4 years, interestingly, an academic did work looking at the causes of that recent downturn and really convinced the public that it was not Grover Cleveland who was at fault for it. So his public perception was able to improve so much that by 4 years later, he was able to run again and actually win the presidency. So at a time when academics had a very strong voice in public perceptions of political candidates. Very interesting. So of the 3 trivia questions we have here today, this one's my favorite because it's the most shocking. So which US president spent his entire campaign budget on liquor to serve to potential voters on election day? I'm pretty sure this would be illegal by today's campaign finance laws. But it's also a little bit of a trick question because it's George Washington before the founding of the United States. In 1758, when he was running for the House of Burgesses. Interestingly, in the previous election, he lost because his opponent did exactly that and spent all of his campaign budget buying people drinks on election day. A couple of years later, when George Washington was running again, he said, I know how this works. And so he took that exact playbook from his opponent and won that by a landslide. So often when I sort of like talk to people about investing in an election year, I ask if you feel like political polarization in the US has increased. And almost universally, I will get nods. And that might be whether I talk with old folks, young folks, center of the country, the coast. Democrats, Republicans, whomever. I think everybody can agree that there's been an increased amount of polarization. And I want to confirm this is not all in our heads. This is actually true. And so this here is one particular survey that shows that. There are plenty of others that demonstrate the same trend, but this comes from the Pew Research Center, which, if you're curious, has a great website, lots of publicly available data with really nice explanations and other charts that are available. And I particularly like this because it goes back a long way. And what you can see here is back in 1994, so when I was graduating college, on average, when people were asked if you distrust both political parties, only 6% of people said yes. That's a remarkably low number. Today, or in this most recent poll that we have, 28% of Americans polled said that they distrust both parties. Now, the other interesting thing is when I have shared this data with people in person, almost universally, I get the reaction like, wow, 28% sounds low. So there has been this very pervasive view of lack of trust in our governing institutions. And again, this polarization is beyond just the political parties. We see it with many government institutions as well. So there has been a challenge, and this makes it much more difficult to govern. But the real reason why I want this up here is because to demonstrate how your political views impact your economic views. And this is where we get into how the impact on the market happens. So if we look at, this is another very common poll that's been around for a long time, University of Michigan consumer sentiment data. And this generally asks a handful of different questions from consumers about how they're feeling about the economy. But then at certain points during the survey, they've also been able to separate it into whether people are affiliated with the Democratic Party or the Republican Party. And it's quite remarkable. Like, look all the way back to Reagan's administration in the 1980s, Republicans felt significantly better about the economy than Democrats. And sure enough, in Obama, it was the reverse. Trump, it was the reverse, and then reversed again under Biden. And so there's this very persistent theme of if your person is in the White House, you are going to feel a lot more confident in how the economy is going than if it's the other party. Now, you might say that, well, if I'm a Republican and I elect a Republican leader, that leader is naturally going to have economic policies that benefit me. That could be true, but actually when you look at the more detailed data, what you see is that those sentiments start to change long before the individual is even in the White House. Forget about having the ability to pass laws and implement policies. So we can look at these most recent data during the Trump and Biden administration. And what you'll see on the left there is Republicans under the Trump administration felt much, much better relative to Democrats. And then you'll see there where the presidential election happened, and those two actually start to reverse long before Biden is even elected. But then during all of Biden's administration, then Democrats feel much better about the economy. So just keep this in mind that we are heavily influenced by how we're going to vote at the ballot box and how we feel economically. Now, I will note, you'll see in the bottom right-hand corner there, we have a little arrow showing a slight uptick among Republicans that happened to come right after the Biden-Trump debate. So it felt like some people were starting to factor in a likely Trump election right after that debate. Now, with Biden stepping down and Harris coming in, it's a whole new world. So we'll have to watch this data carefully to kind of see how consumers are incorporating that into their current view of the economy. And one other point to drive this home is that anytime you look at economic data, depending on which side is talking about the performance of the economy, you might get very, very different descriptions. So, folks who are supporters of Democrats will talk about great increase in hourly earnings, huge amount of jobs created. Unemployment rate is among the lowest that we've had in 7 decades. Inflation down significantly, economy growing much stronger, stock market up almost 40%. That's a really good picture. But if you're on the Republican side, what you might do is look at the decline in consumer sentiment, talk about the increase in gas prices and food prices, the fact that even though earnings are up, real earnings are down. Also, mortgage rates are up, housing prices are up. So again, just be very careful that the economy is a very big, complicated picture, and depending on what your sentiment is, you might be pulling out positive or negative pieces of that. So in addition to that, what we did was look at how the S&P 500 tends to perform in an election year versus a non-election year. So we go back to 1928 and we sort them out into election versus non-election years and then average them out. So on the right, you'll see here that dark line shows, let's start with the non-election year average, which is that red dotted line. So makes sense. On average, over time, S&P 500 tends to go up from one month to the other. The one exception is September, which tends to be the most rocky part of the month. And that seasonality is sort of well known in investing circles. But what's interesting is that if you look at only election years, you'll see a very different trajectory. And that first half of the year is actually pretty flat. And then by the middle part of the year starts to catch up. Remarkably, the S&P 500 tends to have almost exactly the same returns in an election year as it does in a non-election year. And I think that's the most important thing to keep in mind here, is that while elections can impact the trajectory of the market in the very near term, they tend to have very little impact in the medium to longer term on the market. And this is the most important thing for an investor to keep in mind. If you're an investor in the market, tendency is that you're going to have a longer term time horizon. You're going to be thinking about retirement or buying a lake house or sending your kids to school. These are things that tend to be years out into the future. You don't want to be trading for a market that might hit a bump in the next 4 weeks, especially when the market is likely to continue rising shortly after that. Now, I will note, so let's take a little bit of a closer look as to why the market underperforms or tends to underperform in the first half of the year. And so if you think about what we'll call pre-primary season, so the first couple of months of the year when the market, when an election year market tends to really lag a non-election year market. So think about what's happening in the election cycle at that point. Often on both sides of the house, you'll have a wide array of different candidates who are jockeying with each other to get on the public stage. They're stumping around the country, trying to get primary voters out there. And there's a fair amount of mudslinging, even within each of the different parties. So when you think about an investor, what the market likes the most is certainty. So in an election year, this is the highest point of uncertainty in the market because you don't even know who the two candidates are going to be. So now as you fast forward into the primary and caucus season, so the number of candidates starts to get narrowed, and then we start to see the conventions for the two parties where the candidates are nominated. So you'll see there, that's typically where the election year average starts to catch up with the non-election year average. Because by the end of that period, generally speaking, you have two primary candidates. And even though there's still uncertainty about which candidate it's going to be, it's much easier for the market to forecast what life will be like under each of those two candidates, right? When you have 10 candidates, that's really hard. It's a really wide array of different outcomes. Now, I will admit that this year, we've actually had a really good year in the market. So the question is, why? And I think it's because if you go back to that first trivia question that we had, this is the first time in a very, very long time where starting in January, we pretty much had two candidates. So it was like we sort of skipped all of that primary and caucus season, where even though, again, there's still uncertainty about who's going to be the next president, as of January, most anybody was predicting that it was going to be Biden and Trump. And not only were we down to two candidates, but both individuals had served as president. So we had a pretty good sense about what life would be like under each of them. And from the market's perspective, that's a very low level of uncertainty. So then, of course, we get into the general election campaign, where in most years, the S&P 500 actually looks pretty similar to what you have in a non-election year. And then post-election day, so the polls come in, generally speaking, we know who's going to be the next president, and that tends to be a pretty good seasonal period for the market. And so we see markets kind of off to the races. And I would argue in the second half of the year, it's really that elections is taking a back seat, and it's fundamentals that are able to drive the market. Now, one other key difference in an election year versus a non-election year is volatility. Because even though the market is going up, it can be quite bumpy along the way. So let me explain what you're looking at here. This uses the VIX, which is an indicator of volatility in the equity market. So how much does the market think stocks are going to bounce around from day to day? So that red line is a non-election year VIX. So how much does volatility increase or decrease in a typical non-election year? So you'll see there August and September tend to see an increase in volatility. So again, that's a well-known kind of seasonal phenomenon. If we look at that blue line, that shows us the average of volatility in an election year. So it kind of makes sense with the narrative why we see a different trajectory. So look there in January, February, March, volatility is running well above a non-election year. Again, this gets back to primary and caucus season. There's a lot of uncertainty. Then it starts to calm down. And then shortly before the election, then we have this big spike up in volatility. As the election is really heating up, some markets are going to have ad campaigns all over the place. There are debates on TVs. Newspapers are full of headlines about the election, sort of height of uncertainty heading into those election days. But then notice then how volatility starts to subside shortly. And in fact, volatility begins to subside even before the election happens, and then continues to subside into December. You will see there too, we added in the year-to-date volatility just for comparison. So just like in terms of the S&P 500 returns, so we've had really good returns this year, volatility has also been low, but you'll note there that it's starting to tick up again. So we've been talking for a while about the likelihood of a high amount of volatility late in the summer, early in the fall, as we really get into the last couple of months of the election. Now, we've also had a big surprise. Often we can expect volatility, we can expect surprises, even if we can't tell you what those surprises are going to be. And so sure enough, a couple of weeks ago, Biden stepped down, Harris has effectively taken his place. And so we're back into this really uncertain period where we know a fair amount about Trump because he served as president before, and he's been stumping for a long time. So he's been out in public talking about things. Harris, on the other hand, has been a very, very quiet kind of politician over the last couple of years, and only in the last couple of weeks has really started to come out in front and hasn't had nearly as much time to really talk about what her policies are. Now, she previously ran for president, but as we think about uncertainty, which the market hates, there is a higher level of uncertainty today than there was a couple of weeks ago. So we still feel like we should expect a higher level of volatility over the next couple of months as we get into the actual election. I would also caution, because we've had a whole bunch of questions come in before this, which thank you very much. But a lot of questions, and we'll talk about this a little bit more, but a lot of questions about concern around the election and, should I move to cash? Should I step out of the market? What we find is that the market around elections tends to pick up before the election even happens. And again, if you think about it over a full year, the market tends to have similar returns in an election year versus a non-election year. So I encourage people to zoom out a little bit and not look at November, but think about a multi-year period when whoever's elected during that time period will probably have a limited impact on the economy and the market. Now, a lot of people don't like it when I say that. A lot of people don't like the fact that whoever they're excited about voting for has actually very little impact on what will happen with the S&P 500 or with the broad economy. So let me tell you why I think that. So I told you I like data and I like charts. So here's one where we went back to 1929 and we looked at returns in the S&P 500 by president. So red bars are Republican, blue bars are Democrat. Kind of looks all over the place. We did that same exercise and looked at annualized returns by president to try and see if another pattern emerged. Again, not very much consistency between Democrat and Republican. And in fact, those, if you look at Hoover down 23%, that's Great Depression time period. So there are usually macro reasons why a market is underperforming versus a Democrat or Republican president. Then we did one more step where we rolled up all the Democrats, we rolled up all the Republican presidential periods, and then we broke it down by whether it was a Republican president with a Republican Congress or a split Congress or Democrat Congress, and the reverse. And again, what you find here is that there's just no, at least I don't see any correlation between who's in the White House, who's in Congress, and what actually happens in the S&P 500. And remember too, even though we're going for about 100 years worth of data, there are only so many data points during that time period. And so that's why even if you see different numbers that pop up here, you don't want to say that there's a strong correlation because there might only be one or two observations for each of those bars. But there, again, there's good reason why the individual who's in the White House only has a very limited impact on the economy and the market. And I think that's a huge strength of the United States, which is that we still have these really strong, several hundred-year-old institutions that provide structure and continuity from one administration to another. And I really think the strength of American institutions are a huge advantage for the US economy, and I think really distinguish us from a lot of other countries. You know, you might see Argentina or Mexico recently had elections where, you know, in Mexico's case, a surprise candidate won and markets were gyrating all over. Venezuela, we're having a contested election right now. But Venezuela is essentially a failed state. And so these are not enviable. And in countries like that, it makes a huge difference who gets elected or who takes power. In America, it's really the institutions that provide that direction. So I take great solace in that. One of the other things that I get a lot of questions about is US debt. So this is another one where we looked at the increase in Treasury debt by administration. So same exercise, looking at it by Republican versus Democrat. What you will see there, and it's kind of tremendous. It was like I knew this, but it really drove home once we actually created this chart. Since President Truman, every single American president has increased debt. Doesn't matter if they're Democrat or Republican. We did a similar exercise then and took the amount of debt and looked at it relative to the economy, because that's really a fairer way to look at it. And again, red is Republican, blue is Democrat, same thing. From that time period, even when you're measuring the debt compared to the US economy, you will see that it has been on basically this increased trajectory from 1950s. Now, those periods where you had a big drop down, right? So a big increase in deficit relative to GDP tended to correlate with big macro events. So you'll see the global financial crisis, you'll see COVID. Those were big things that really drove a huge amount of government spending versus party policy, right? And so that's an important thing to keep in mind. Now, this is not to say that US debt is not an issue. US debt is an issue. So when we look at the amount of fixed income or the amount of bonds that need to be reissued over the next couple of years. So initially we did this exercise when we were doing some work on commercial real estate. And we were concerned that with a lot of, you know, particularly office buildings that were essentially going bankrupt, there would be this cliff of debt that was coming due that was going to pose a big risk to debt markets. So we looked at all different types of debt and then looked at what year they're maturing and then stacked them on top of each other. What's interesting is that if you look at those colored bars, you'll see that there's no huge sort of cliff of debt that comes due over the next 4 or 5 years. There's a fair amount of debt, higher interest rates have an impact, but there's no huge amount. But of course, you see that dark blue bar, and US Treasury debt swamps every other type of debt. And about 30% of federal government debt matures in 2024. So it's a tremendous amount that needs to hit the markets. This is not wholly unusual. It's a little bit higher than what we typically see. But then throw on top of that, you have much higher interest rates and you have a contested presidential election. So, you know, naturally, there's going to be a lot of focus on this. And then a longer term trend is that some of our largest buyers of US Treasury debt have started to retreat from that market. So think like Japan and China, who have long been huge buyers of US debt, have been buying much, much less. And with that, we've started to see a number of auctions. Technically, the term is failed auctions. It sounds a little bit more dramatic than it is. But what that means is that when the Treasury comes to the market and offers bonds, they've had fewer buyers than what they had anticipated. And so what it just says is that it's going to be a little bit harder for them to find homes for all of this debt. Now, again, I mentioned that I often get questions about this. And in fact, I've been getting questions about this my whole career. And for much of my career, when people ask me, am I worried about US debt? I would say, no, not really. Because the amount that the US government pays to service that debt was among the lowest that we had ever had. So think about why that might be. Even as debt overall went up, interest rates were going down. So as that was happening, the bill for paying off all that debt got to the lowest levels that we've seen in about 50 years. So the market was telling us that they're not worried about the US government paying back their bills. But that's all changed with higher interest rates. So this comes from the Congressional Budget Office. And what it does is that dotted line shows a projection. Let's assume that government debt stays the same, which it likely won't because it's projected to increase. And let's assume that interest rates stay the same, which they also probably won't. But just with those two naive projections, you can see that within 10 years, we're well above any peak that we've had in terms of the amount of dollars it takes for the government to pay its debt. So this is why it's an issue. But I will say it's not a party issue. Whoever ends up in the White House in November or in January of next year will have to contend with this. And their ability to contend with it will be very, very limited simply because most US government dollars go to things that both parties have said they're not going to touch. So think things like Social Security and Medicare. So the ability to bring down US government debt is actually quite limited. So this will be an intractable problem. This will be something that will be around for years to come. I'm sorry to report. All right. So with that, let me just click to the summary. And before we go through this, there is on the bottom of your screen a button that says Q&A. If you are interested in asking a question, please feel free to click on that. You can type something in. I know I've gotten a whole host of questions, which we'll talk about here, but I always love to hear what's top of mind for everybody. But if I want you to remember anything coming away from this is that the return of the S&P during an election year is almost identical to the return in a non-election year. So over time, the market tends to perform the same. This political risk that we have, the volatility associated with an election is short-lived, and it tends to subside even before the election. So if you're out of the market, worried about volatility, don't wait until the election and before you get back into the market. And think about some of these longer term trends, the impact of the party that's in power on the trajectory of the economy and the market is very, very limited. And that's a good thing. That is a really good thing. All right, so let me get to some of these questions. And I'll just read some of these so some of our listeners can get a sense of what other people might be worried about. So it looks like it's going to be a bumpy road, just making sure we're in a good place. We have money sitting on savings, not making anything. What should we do with it? Would it be wise to move toward a more conservative investment strategy with the coming election and ongoing wars? All right, that's another one. A third one, whether or not to invest a large sum of money given the stock market heights in upcoming election. Okay, and then finally on this theme, we're expecting turbulence no matter which side is elected. How can we safeguard our investments? So there's this clear theme, right, of anxiety heading into this concern, again, on both sides of the aisle. But I go back to data, and the data tells us that this is short-lived. So then when we think about more generally, like where is the market and the economy? So let me just spend a moment on that, step outside of kind of politics themselves. When we think about the economy, what we've seen is that the economy, like GDP growth or overall economic growth so far this year has continued to be much, much stronger than what was expected. And that's at the same time that inflation has been coming down. So we've started to see some of those overheating areas bring price increases down. Now, prices are still a good bit higher than where they were a couple of years ago, but the price increases are slowing, which is exactly what you want to be able to see. With that, corporate earnings have increased substantially. So we're expecting corporate earnings to grow at about 10% this year, which is about in line with your long-term average. So you have this really great macro backdrop of a stronger than expected economy, slower prices, companies making money, and then also add in the Federal Reserve, which is expected to cut interest rates starting in September. So you'll get a little bit more juice, a little bit more of a tailwind, if you will, with those lower interest rates. The one concern that I might have is simply that valuations are high. So if we look at the price to earnings ratio for the S&P 500, it's currently running at about 21 times. Average is about 16.5 times. So we're expensive relative to where we would typically run. But I would argue that a lot of that is driven by just a handful of names. And so we see a lot of opportunity outside of, some of the names that have really been in headlines lately. And so as you think about sort of bolstering your portfolio to go through a volatile time, I really like to advocate going back to investing basics, which is really to make sure you have the right level of risk for your portfolio over the long term, right? Not thinking about just the next couple of months. And make sure that you hold a variety of different asset classes. So you don't want to own just the Mag 7. You don't even want to own just the S&P 500. You want to be able to have exposure to stocks outside the US. You want to have exposure to fixed income, different types of bonds, and that really will help mute any sort of bumps along the road and help provide a more even trajectory for your portfolio. These are times where, though, easier said than done. I think these are time-tested strategies for building wealth. But as you go through this really anxiety-ridden time that we call a presidential election, I get that it's hard to do. But that's really the key to growing wealth over time. All right. So I see a question here on same true for Bush's and Clinton. I'm not sure which slide that was related to. So Brian, if you don't mind putting in some more details about what that question was related to. A question here about government deficit. We have a couple of other write-in questions from earlier on this topic as well. So if we're tracking nearly a $2 trillion deficit, how will the government pay that rising interest expense? I mean, that's a great question, right? So naturally that comes just from the budget. So if you have to pay more on your interest, you're going to have to take away from other things that you would normally spend money on. And as I mentioned, things like Social Security and Medicare, both parties have said that they're not going to touch. So it has to come from the discretionary part of the budget. So those are things, a huge variety of different type of programs that the government support. And that's where it'll have a big impact depending on which party is elected, because each party has very different views on which of that discretionary spending should be decreased. But in general, what we think of is that as the debt costs go up, there's less government spending, which becomes a weight overall on economic growth. So it almost becomes a bit of a wet blanket on growth going forward. Okay, so there are also some questions about tariffs. So how will Trump's proposed tariffs affect the market and the economy? And I see here too, how do tariffs include how do tariffs impact the Federal Reserve decision on interest rates? And it's funny because I got a question on that. I was on Bloomberg Radio a couple of weeks ago, and I got a question on this, and they were, asking me about the impact of Trump's proposed tariffs on inflation and the Fed's ability to offset it. And it's a totally fair question, except that Democrats also have tariffs on different countries and different types of products coming in. And so it doesn't necessarily mean that this is, again, a party issue. This is a tool that we have seen both parties use, sometimes on different types of products. But in fact, a lot of the tariffs that were put on during the Trump administration have been kept on during the Biden administration. Now, all that said, tariffs tend to be inflationary. and they tend to depress consumer buying power. So if you think about it, if there's a computer chip that's made abroad and it suddenly costs more for an American's probably going to buy fewer computer chips. Makes sense, right? So that means overall less consumption that's happening. But so far, we haven't seen that huge an impact from tariffs because of the limited amount that they've been used. But this will certainly be something that we have to watch and see if the approach to tariffs changes significantly, and then how it might impact prices of certain goods. Okay, so a question on fixed income, which is what to do as bond yields fall below 5%. So this is a great question for a lot of different reasons, because I think it hits on a few different trends that are happening. So right now we have short-term interest rates at 5%. The Fed, as of its meeting just a couple of days ago, sort of hinted that it was going to start cutting interest rates beginning in September. So that 5% interest rate is likely to start to come down. And that's for very short-term interest rates. Let's not forget that we still have long-term interest rates that are not controlled by the Fed, that move around more as it relates to things like inflation and economic growth. Right now, short-term interest rates are actually above long-term interest rates, which is unusual. Usually they're the other way around. So as the Fed starts to cut short-term interest rates, the question is what will happen on the long end? Will those go up, down? How do we get back to kind of a more normal place? So as it relates to how you treat then how you have your money and investments, think about the fact that if you have money in savings account, checking account, money market fund, these are things where the yield will move around depending on those short-term rates controlled by the Fed. So starting in September, that rate's going to start to go down. Now, it'll go down slowly. I think markets currently have 10 interest rate cuts baked in over the next year and a half. So it'll take some time, but just know that that 5% is not fixed. It will start to come down. On the long end, my guess is that interest rates probably stay around about where they are here today, partly for the reasons that we talked about, and that there's a huge amount of treasury debt that needs to get issued that will kind of keep a floor on some of those rates. And the economy continues to have a pretty good outlook, and often the long end of the curve will be tied to that. So depending on then how you're invested in a fixed income portfolio, I talked earlier about diversification. So you want to also have a diversification of what we call duration. So you want to have some shorter term bonds, some more medium term bonds, and some more longer term bonds, so you can kind of manage through that reversion of the yield curve as you go. All right, so hopefully that's a helpful answer. And this is related to that. So do you expect the market to have a very volatile reaction, good or bad, when the Fed finally lowers interest rates? If so, how would it affect your strategy? So you probably know that investors love to think about the Fed and to parse apart every little word and to spend a lot of time forecasting what they're going to do. So this is something that we think about a lot. And as I mentioned, the Fed just met a couple of days ago and kind of did just what we thought it would. And I will note, so Chairman Jerome Powell, who has been head of the Fed now for a number of years, has kind of made a name for himself in that he is a good communicator, and he spends a lot of time trying to prepare markets for any change in policy. Now, during COVID, that whole playbook kind of went out the window simply because the economic environment was changing so quickly. We've really never seen anything like that in modern times. But once the economy started to normalize, he went back to that old playbook of taking time to kind of warn people about where they were going. So all that's to say, in the most recent Fed meeting, there were a lot of hints that the Fed is prepared to start to cut interest rates in September. So barring any real new economic data that's unexpected, we would expect the Fed to indeed cut interest rates and look for hints about what they'll do at future meetings. All that's to say, we don't think that there will be a huge reaction, positive or negative, to the Fed cutting interest rates in September, simply because they've already been doing a really good job of forecasting what they're going to do. One other thing, at the risk of being really long-winded, Where you did see a big change in the market was a number of weeks ago when we first got some additional confirmation that inflation was slowing. So when that happened, we got a number of different economic data points that were saying that inflation was slowing, just as the Fed had hoped. With that, the market already started to move and say, okay, the Fed is likely going to start to cut interest rates in September. We're going to start investing our dollars like that's going to happen. And with that, we started to see a really important rotation in the market out of, what's often called the Mag 7 or the Magnificent Seven, which is a handful of names that are really, really large that have really led the market over the last 18 months. So what we saw is that investors beginning to move out of those names into other types of names, so particularly smaller names. And in fact, it was the first time in I don't know how long that we saw the Russell 2000 or a small cap index actually outperform the NASDAQ. Now, this doesn't happen all in a straight line. It will be bumpy, but we do think as the Fed continues to cut interest rates, there's an opportunity for the markets to start to broaden out into these other types of asset classes. Okay, let's see. Do you see a housing bubble popping? I've seen prices coming down from record highs. So for sure, this is housing is a really, really important part of the economy. So we see a lot, we spend a lot of time kind of like thinking about it, looking at data across the country. Now, I will note housing is particularly tricky because it's very dependent on your particular region. And in fact, I live in Austin where house prices were crazy just a couple of years ago and have definitely subsided. But even my experience in my neighborhood is different than colleagues of mine who live in other areas of Austin. So different cities will be different neighborhoods will be different. When we think about it overall, though, we do not see a bubble in housing. A couple of reasons why. And I say this with great sort of concern because, I lived through the global financial crisis. I was a financial stock analyst during that time period. And leading into that was very, very negative on housing for a couple of important reasons. In 2007, there was an enormous amount of very aggressive financing on the part of different types of banks and mortgage companies. So you could see individuals that were taking on a huge amount of leverage without having to prove their, income or job or anything like that, to move into bigger and bigger homes. And it was pretty evident if you knew where to look in the data. It was fairly common to have people put 1-2% down on a house. And you could see when you looked in aggregate at consumer debt relative to income or net worth, it was the highest that we've seen in a very, very long time. When we look at those numbers today, excuse me, most Americans are in fixed rate mortgages, which are much safer, right? Because even though interest rates have gone up, most people have mortgages with interest rates down here. We don't see a lot of what we call creative financing, where people can only put down 1 or 2%. And when we look in aggregate at consumer debt relative to either income or net worth, it's not high. It's not anywhere near kind of previous highs that we've seen. And then throw on top of that, the labor market is pretty strong. And we still have a housing shortage. It's incredible to me that we still have a housing shortage, like decades after we started beginning to talk about it. But believe it or not, this country just does not, oh, thank you, John. This country does not produce enough homes for the number of people who need them. So on the left here, you'll see fixed rate mortgage, right? So we got up to 8% not that long ago. And we're the highest that we've been since 2000, pretty much. So even though interest rates are very, very high, and to buy a home today, your mortgage rate is going to be very high. If you look on the right, this is looking months of supply for existing homes. And even after interest rates have gone up as much as they have, we still have fewer homes for sale than we typically do. And so what that means is that kind of buoys home prices. And so that's hard for folks who are looking to buy homes, right? Because affordability is very low and there just aren't a lot of homes to pick from. But in terms of like the macroeconomic risk, we think it's really limited. Okay. How much is the stock market impacted by the regulatory outlook ahead of the election? Since Democratic administrations tend to increase regulation on business, Republicans prefer deregulation. How big a factor is that in the election outcome? So I think this is very important for certain areas of the economy. And so, I mentioned during the financial crisis, I was a financial stock analyst. So I covered, just imagine every financial company that was in the headlines at the time. So think Bank of America, Citi, AIG. These are all companies that had extraordinary financial stress. And then coming out of the financial crisis, there was a huge amount of new regulation, higher capital requirements, new disclosure laws. Regulators went on massive hiring sprees and essentially hired armies of people to go into these banks and sit in the banks and be on-site regulators. Very, very heavy impact on those companies' ability to improve returns because they had to hoard so much more cash and because they had to spend so much money on these new regulations. It's been very difficult for these large banks to kind of build back to profitability. And so that's where, the question was really about Democrat versus a Republican. This was very much a Democratic approach, but it was pretty widely, it was pretty popular among the general American population because those banks had such negative reputations coming out of the global financial crisis. But that went on for at least a decade. And that was where during different elections, financial companies would trade quite differently depending on which administration was coming in. Healthcare is another one that historically has been very impacted by whether it's Democrats or Republicans. So in certain areas of the market, it can make a really big impact depending on how that particular party views you. Energy is another one that is quite typically correlated with Republicans being much more supportive. So often when a Republican administration is put into office, energy stocks will perform better. But then interestingly, there are other industries that change depending on the sort of view du jour. And the most interesting one recently, I think, is defense, where typically defense has been very supported by the Republicans. But now with opposition to funding for Ukraine and Israel, now it's the Democrats who are seen as actually more supportive of defense stocks than Republicans. So the answer is yes, but sometimes it's a little hard to forecast which area of the market is going to benefit from that administration. One other one that I'll mention is not necessarily with regulations, but with subsidies. So solar is a good example of an area of the economy that is very impacted by government subsidies. And we see this outside the US as well. So whether or not there are subsidies for those types of purchases can have a huge impact on revenues for individual companies. So it's difficult sometimes to forecast. All right. So I think we have been through all of our questions. I want to thank everyone very much for joining us today. And again, if you're anxious about the election, I share your anxiety, but be very careful when you allow that anxiety to translate into your portfolio, because it may not necessarily be the best thing for your portfolio. But, and I don't want anyone to think that voting for your next president is not important. It is very, very important when it comes to policy. Just don't worry about it when it comes to your portfolio. So please keep an eye out. We'll continue to write and talk about the election over the next couple of months. This replay will also be available. Just give it a couple days to kind of get it through approval and post it up online. And please, we always love to hear your thoughts and questions, so keep them coming. Thanks so much. Take care.